way, there is no limit to the opportunity that you have. Try to increase your income as fast as possible. Rest of the thing about asset allocation, investments, products, stock, it's a solvable problem, right?
And for that, Candor is there.
For that, Candor is there.
Yes.
Correct.
People who have left the entire home country have gone to the US, settled there.
Because we thought that Trump is our friend, but he's ended up taking Panga. So as investors, we have to prepare for turbulent times. Ups and downs are normal in any market. Time to invest in India is now. There's a very high chance that the dollar is going to be devalued. The mistakes that you don't have to make, don't try to make it too fast. So people want to buy commercial real estate. People suddenly want to go to private equity. I'm not saying private equity doesn't make money. Upgrade yourself, go around in the world, take some courses, meet some new people. Finding the correct investor is difficult for the advisor. Finding the correct advisor is also difficult for the investor.
Before we begin, a very quick disclaimer. Please remember that the information in this conversation is only for educational purposes and it is not a financial advice. Spring Money is a platform that connects you with the qualified advisors, SEBI Regulated Advisors. If you find this content valuable, we would like you to share, like, subscribe. Feel free to ask any of your questions in the comments below, and you can learn more on our website. Link is in the description. Hi Amey. Again,
Hi, Nikhil.
Welcome to Spring Money.
Thank you.
So we'll start at a very basics. So at Candor Investing, you are managing a lot of wealth for the people. But I think let's start at very basics of it. First of all, let me know or let our audience know, what is Candor Investing? I mean, and why specifically Candor as a name? What is the thought process behind that?
Basically, we are financial advisors, okay, and typically equity advisors.
Okay.
And the problem with equity is that it goes down in value, right? And in most cases, it's a surprise to our investors and to us as well. So the nature of equity is that it will go up and go down for random reasons. First is we are not able to pinpoint what the reason is many times, nor predict it, right? And not even able to prevent it. So drawdowns in the portfolio are given. We have to prepare for it, right? At that point of time, being open, transparent, forthwith, right? And upfront is very important for us and the investor to keep faith in our investment process and stay along and take the entire journey of what we call as long-term wealth creation, right? That is very important. And that is why, this name of Candor Investing, whether we do a good job or a bad job with your investments, of course, we will do a good job, but we will always be forthwith, transparent, and upfront about our communication with you regarding the investment performance and what you need to do. So I'll extend this a little, Nikhil. So what also happens is that people come with a certain expectation or a problem or a problem statement, right? Yeah. Many times we have to educate them that what they're asking for is wrong. So if somebody, I'll give you an example, okay? Somebody came to me, he said, I want 20% returns, right? And I want you to beat the market. So this was, I want you to beat the market. So I said, fantastic, I'll beat the market by 10%. Is that okay? Yes, superb. So if the market does 20% returns, my returns are 30. Are you happy? So he says happy. If the market does minus 20, I do minus 10. Are you happy? I said, no, how can you lose money? Right? But here I have to tell him, if you want, yes, I can beat the market, right? But if the market goes down by 20%, your portfolio will also go down. You have to digest it.
Yeah.
So this is what our basic philosophy is. Be transparent with the investor.
No, really wonderfully put. I think being forthright and being very, very transparent in today's age, especially in terms of what we all are seeing in the social media, is extremely important. Because I think setting the right expectations for the investor actually is a half job done. Because then the investor actually is enjoying that peace of mind, enjoying that confidence, and definitely then you have gotten that trust that, okay, this person is honest. And I think in money management, honesty is the best policy. And genuinely rightly said. But I think if I double click on it as an investor, now I understand and I want to work with someone like who is honest with me, someone like Candor Investing. What can I expect as part of your services? What are the different products or a bouquet of products that you offer? Because when people say stock advisory, it can genuinely mean from actually investing to F&O, where we have seen so much of market turmoil, so much of people losing money also. So as an investor, as someone looking to invest or start my journey with you, what should I expect as part of your services, and what is the typical process, or what do you look for in terms of choosing your customers?
Fair enough. So let me tell upfront, I'm very greedy. What do I mean, right? I want to make a lot of money, but I can't make a lot of money in the next 6 months, 1 year, 2 years, right? It's a long drawn out process. So over a 10, 15, 20 year, I want to make a lot of money. The process that we follow is long-term investing, right? Invest in the good quality companies at low valuations and have the patience to hold them for a long time. This is what has worked wonders over the last several decades and probably a century, more centuries, right? Across geographies. So this is the kind of investment that has the highest chance of success. Okay, so let me now explain quickly what kind of products we have and what kind of investors do we serve, right?
Yeah.
So essentially, we are stock advisors. So we have a stock advisory portfolio. So no F&O, no short-term trading, pure fundamental long-term investing, what broadly called as value investing, right? That's our main bread and butter.
Yeah.
We also have what is called as a small case, which is basically a model portfolio. The difference between the two is that you could be somebody where you come, okay, I have this X amount. I want you to take, give us advice on the entire amount of what I should do, where I should invest, which stock should I invest, what percentage, how many stocks, 5 stocks, 10 stocks, whatever it is, right? So then we take the responsibility for the entire portfolio of that amount. Right?
Yeah.
So if you may have 100, you may say, I'll invest, say 50 with you, for example, right? The other part is many of them come and say, okay, I like your investments, I like your philosophy, I have heard good things about you, but I want to take my own decisions. So if you recommend me 10 stocks, maybe, I will like only 2 stocks, I may not like the other 8, but I don't mind paying you for that.
Okay.
So we take a fixed fee and we'll give you a list of stocks and our research on it, which is hosted on the small case platform. So it's like a model portfolio. You buy, if you like the entire portfolio, you buy the entire portfolio for the amounts that you want. Or you may pick and choose, I like these 3 stocks, I don't like those 4 stocks, something like that. And we also have, because, I think just stocks is not everything that a person needs. Sometimes because these investors also trust us, value our advice, we also give them a overall financial plan or a mutual fund advisory. But this is typically restricted to people who have been there with us for a period of time.
Surely, and I think you rightly touched upon that. This is a fantastic way of putting 2 different value propositions or product proposition based on the needs of the customers, because I'm very sure you would have experienced that different people need different things at different times. It might also come that at a very young age, I might need only a model portfolio, but definitely at a slightly mature age, I might need a holistic advice like a financial plan, or someone who is going for stocks when they have a lump sum kind of investment and they want to generate. But in that, of course, the famous and the very, very popular question is, what do you charge and how much should I pay?
Okay, so I'll describe this from the stock portfolio perspective, right? So SEBI has actually prescribed what fees we can charge and how we can charge them. So typically we are allowed to charge a percentage of the fees up to 2.5% of the portfolio. So whatever is the market value, what we charge is we charge 2% per annum. We charge at the end of every 6 months 1% plus GST, right? So per year, whatever is the value, I take an average of all the 365 days of the portfolio and charge you 2% plus GST at the end of the year. There is also an option to charge a profit share.
Okay.
In case you get certified as an accredited investor. What basically SEBI is saying, see, the biggest job of SEBI is to protect the investor from untoward practices, right? So that's why they have prescribed what fees I can charge as a regulated entity.
Yes.
So accredited investor is somebody whose net worth is more than 7.5 crores, approximately $1 million, right? So SEBI says if you have more than $1 million or you have more than 7.5 crores, you basically know what you're doing with your money, you know what risks you're taking, you have done enough due diligence, I don't need to overprotect you. In that case, we also offer the option of a profit share at the end of the year.
Okay.
Right. There typically we charge about 1/8 of the profits in the portfolio at the end of the year plus GST.
Okay, superb. Now I'm very clear what you have, why Candor, what you have, and definitely what do I have to shell out. Now as an investor, I have some specific doubts because I'm coming, imagine that I'm an investor who is trying to get Candor. I'm very clear, I understand that you are honest, and I love that honesty because it is ultimately my money that I'm going to give it to you. In that, I'm very sure you must have come across many anxieties that people have. I also have as an investor. And what are those specific anxieties that in the so many years of your career that you have come across and you have seen that they playing a negative role, especially in terms of journey of an investor, and what are the impacts of those anxieties that you have seen?
So the biggest challenge that I have faced as an advisor, okay, is, and it's a genuine concern for the investor as well. So imagine, the portfolio is down by 20%. Not very uncommon. It happens, easily happens. It's been, say, 1.5 years, portfolio is down 20%. Is it wrong advice? Is it bad advice? Is it the market? Am I with the wrong advisor? Or is it a temporary phase? See, sometimes I may give a wrong stock selection, right? I may make mistakes in stock selection. That is also true. So the investor genuinely doesn't know what is the problem. Is the market the problem, advisor the problem, or is it just a temporary problem? Is it that I'm invested for too lesser time? Should I wait for another 2 years? And they are correct. They are not wrong in it, right? So it's a genuine concern that anybody has, or a genuine confusion, I would rather say, right? My only take is this. See, you have to control your risk. In what way? There are 2 ways to control risks. One is you elongate your time period of investment. So if you have a long time period, the chances that you will lose money or have a bad outcome dramatically reduce, right? And how much amount you want to put in a particular asset class. So that if you control, then more or less, whatever mistakes or risks or whatever else are there, they go away over a period of time. The second anxiety typically, so that has been my experience. Most of the times they are a little more, they are too conservative on the asset allocation perspective. For example, they may have a portfolio of 2 crores, but have only 20 lakhs in stocks, right? And their income is very good, right? They are at their prime age. So maybe they are 35, 38, 40, right? So they are at the age where the earning is maximum, promotions are faster, responsibilities is good. Next year, salary increments are going to be better, right? Earning potential is good, whatever. If they are in business, then it's a prime of their business. So have the correct allocation. Risks are always there. Markets will always go up and down. But you have to put your best foot forward. So don't be too conservative. Of course, don't be too aggressive, but also I think most of my investors, many of my investors have this problem. They are sometimes too conservative.
No, I think you rightly said. I personally also, I would say it is very, very, in a way, for every investor, it is very big dilemma what that right balance is. And that actually creates a lot of anxieties. But in that time, I'm very sure an advisor like you or advisor like Candor Investing would be really helpful. But for that, what would you advise to those kind of dilemmas or the anxieties? What are top 2 or 3 questions that they should genuinely focus on rather than getting into distracted? Because as you rightly said, there can be n number of variables. But what are those controllable variables that they can think of and then come back to you and maybe have a discussion with you so that that honest conversation can actually reduce that anxiety and give again that confidence back?
So I'll give 2-3 things to think about,
Yes.
okay? Always assume that your portfolio is actually 20-30% lower than today's value.
Okay.
Because markets can fall anytime, your portfolio companies will fall more than the market. So assume if your portfolio today is 1 crore, it's actually 70. So there won't be a mental agony when the markets actually fall, right? Second, you have to look at your advisor, whether he's consistent in his approach to picking investments. Is he saying the same thing what he was saying 6 months back, 1 year back in terms of the overall approach, right? See, the second thing is, people in the markets who are successful, they end up making a lot of money, okay? They may not have too much money now or whatever, over a period of 5, 7, 10, 15 years. If you do well, most of the people will end up with a lot of money, okay? So we are not worried that we will not make money, right? It's a question of time. So time is a big factor. So if your advisor is in too much of a hurry, then that's a big red flag, right? So he has to listen to you, understand your circumstances, understand your concerns, understand your dilemmas, understand your confusions, and then tell you what is right for you, irrespective of whether he's getting the fees, not getting the fees, he's getting lesser fees, higher fees, right? Somebody who is focused too much on the fees is not the correct guy. Somebody who is asking you to be too aggressive, Dalo paisa, put more money, right? Those are red flags. And you have to look at basically, it's like simple as it's very easy for us to make friends, right? We know when we meet new people, we know whether this is somebody is going to gel with us, not going to gel with us. It's not very difficult. It's same with your advisor. His way of operation, philosophy has to match with you. If it doesn't match, or if it's completely opposite to what you think is correct for you, then he's not your correct advisor. It's better that you switch advisors, go to somebody else. Because see, at the end of the day, everybody is giving good advice, unless that person is a fraud, right? It's also the question, can you stick with that advice and implement it over a long period of time? Then it will work.
Yeah.
So it's a team effort.
Absolutely.
At the end of the day.
No, I think, as you rightly said, it looks like more of a team effort, but with a long-term horizon.
Correct.
Which can control my anxieties, and actually it should be given a due time. That time can be mutually decided between an advisor and an investor, but it should be given a due time to flourish, to give its genuine returns, and then you can definitely enjoy those returns. But see, in the era of where we have 30 seconds of reels, it is so difficult. What you are asking is time, which is so difficult. And it is a famous saying nowadays that 45 is the new 60s, in terms of where people genuinely want to retire as early as possible. I mean, 21-year-old might also come to you one fine day and say, "Sir, मुझे काम ही नहीं करना है." But for that 45-year-old kind of a retirement, when it is, yes, it might seem very early, it might seem very fast. But in that, how do you typically approach? If that is somebody is asking you, what is your advice in terms of how they should change their behavior? At the same time, is it genuinely possible? And what is your process or Candor's process to make that confidence, to make those calculations so that they understand, is it possible?
So this is a very different question on a very different plane, right? Only two types of people are working. Those who need to work don't have the money and they need to work, right?
Yeah.
Then there is no advice to be given. You have to work, boss. Okay,
Yes.
you don't have enough money, so you have to work, right? And the second kind is they have enough work, they have done everything else and got bored, right? Now they think that what I'm working on is something constructive, fulfilling, right? That's it. So people who are saying that I want to retire at 45, right, are those people who don't have enough money. For them, the question is, so if you have at least 10, 15, 20 years to reach 45, that's enough for you to make a good corpus. So the concept is basically you have to save at least 10% of your, at least 10%, right?
Okay.
It can go up to 30, 40, 50%, but or at least save 10% of your income. First and foremost, before investing, repay all your debts. As much as possible, don't have debt. There is one small exception. For a house, you can have a debt because it's a long-term, low-cost debt. So 20-year loan with 7.5% is very cheap. So that's fine.
Yeah.
But as far as possible, don't have any debts. Save as much as possible. And over a 10, 15, 20-year period, keep your expenses low. If you can save 25% of your income, that means your expenses are lower compared to your earning capability.
Yeah.
And the third most important thing for today is, today there is no limit to the opportunity that you have. It all depends on how much you learn, how much you apply, how much enterprising you are, right?
Yeah.
So the chances of increasing your income at your job, at your business, or wherever you are working is far more than, say, 30 years back. 30 years back, there was no internet. There was no way to learn new things. It was very difficult. It was a long drawn-out process, right? And you had to be in vicinity of great people who want you and will mentor you and take you ahead.
Yeah.
Today, the possibilities are unlimited, so try to increase your... So one is save, second is 10, 15, 20 years, and third is try to increase your income as fast as possible.
Okay.
And you should be fine. Rest of the thing about asset allocation, investments, products, stocks, whatever investment ideas, it's a solvable problem. Hundreds of people have solved it. It's nothing great about it, right?
And for that, Candor is there.
For that, Candor is there.
Yes.
Correct.
No, absolutely right. I think this is something adds up a confidence, because for someone who is genuinely juggling from their everyday job, and genuinely sometimes the pressure also mounts a lot. I mean, as you rightly said, the world keeps changing. Every 20 years, the world is very different. Now that pace of change has increased. I mean, just very recently, we saw that the entire H1B era H1B phase, where everybody was genuinely worried that should they, the people who have left the entire home country, have gone to the US, settled there, they're genuinely worried that what is going to happen to their future. And in that, I'm very sure a financial concern, because it is about their life, family's life, is a very major one, right? Of course, since we touched upon that on a general note, what's your take on this entire trade war? I would call it a Trump mania, maybe, if you can allow that. How is that shaping up, and what's your take? And again, as an investor, to put that lens onto that, what do you think it has an impact on the markets, or how, as an investor, should I be worried, not worried? How should I look at it?
So I'll put this in a little historical context, right? And we have to also study the history of financial markets. So financial markets always have bull phases and bear phases. So phases, and these phases can last as long as 5-10 years also, right? I'll give you a typical example. In the US markets, the index returns between 1964 and 1981 were zero.
Oh.
In this 17-year period, the economy actually went up some 4 times or 5 times. The corporate profits, that's a measure of P ratio and all that, right? Those also went up some 4 or 5 times. So it was a long period of time where the equity returns were zero. These phases come. In the Indian markets, I think the returns between 92 and 2001 or 2002 were more or less zero.
Zero. Okay.
This was the peak of the Harshad Mehta scam and the bottom of the post-tech burst.
Yes, 2000,
phase,
yeah.
Right? So those 10-year period, index returns are zero, right? These phases come. Right? What is happening in the US, for example, now, right? So the US has been importing from everybody, right? It's the economy to go to, and the most powerful thing. China has come up. What has fundamentally happened is, to fight a war, the fundamental things that you require, like steel, ammunition, medicines, right? Basic industries, all these aluminum, copper, this, that, whatever it is, they have just not existed in the US. Most of them have just gone out. So for the last 30 years, when there was no adversary to the US because the Cold War had collapsed, the US basically, by default, because it was much cheaper, more efficient, and much better to manufacture in, say, East Asia or China, they ended up outsourcing most of the manufacturing to East Asia first, and then by default it has gone to China. Now what has happened is it is concentrated in just one country. So now the US is preparing for a future calamity. Okay. See, second, what has happened, there is a statistic which says that non-graduate white male dies some 15 years before a graduate white male.
Oh,
right?
This is very interesting.
So if the life expectancy for a graduate white male is, I think, 77 or something, the same number for a non-graduate white male is probably 60. Second thing we have to understand about the US society is, I think by default most of them are not graduates. So I think they have this 12 system where, after 12 you can just go and work, become an electrician, become a driver, whatever XYZ, right? It's only in India that we look down on so much for being a non-graduate.
Yeah.
Right? So basic graduation तो चाहिए इंडिया में.
Yes.
उसके बाद post graduation वगैरह चाहिए, वो सब अलग बात है. But in US non-graduate is good enough, right? But that white male non-graduate is dying 15-20 years before
the graduate one, yeah.
Which means those lower earners, see why also they are dying. So we don't need to be very accurate on the reasons, right?
Yeah.
But typically these are lower income, typically, right?
Absolutely.
Second, US has a race problem. Why is there affirmative action? Is because there was genuine race problem. Probably today, even if you go to non-cities in US, there is a genuine race problem. But what has also happened because of that is the white people are getting a bad deal, right? Third, their family systems are not as robust as us, right? What do I mean by robust is that we are far more connected with our cousins, with our parents, with our uncles, with our nephew, nieces, right? There are festivals like Diwali, the Dashera, Bhau-Beej, Raksha Bandhan, all these where, so many people come together. Our marriages are grand and hundreds of people are invited and all that, right? It lasts for 7 days and all that stuff. So these are ways of social bonding, not just celebration, right? These are ways of social bonding. That structures are probably much weaker in the US. And Trump has won because of these people.
Yeah.
And there is a genuine issue. See, that one more study has said is that the wages, inflation adjusted, has not risen for the white male between 1980 and 2025. So for 40, 45 years, these working class, and now I will not restrict them only to the white males.
Yeah.
The working class has not seen any improvement in their lives. All the technological advances and the big money has been made by either the financial investors or the tech investors. Majority of their population is at the same level what they were in 70s or early 80s, right? This has to be solved, and Trump is trying to solve that. How is he trying to solve that? He's trying to solve that by getting manufacturing back so that these guys have at least more jobs, right? The second problem that has happened, and we have to give it its due weightage. For almost 12, 13, 14 years after 2008, we were in a zero interest rate scenario.
The
Okay.
so-called Zhar Pera.
Correct? And it was so long that, so there are theories in economics, right? Milton Friedman versus Keynesian theory. So Keynes said that inflation can be controlled by fiscal responsibility. So you reduce the government spending and keep the budget low, inflation will be controlled, right? Or you increase interest rates, right?
Okay.
So increase interest rates, keep the government spending low, you will control inflation. Now Milton Friedman said that essentially inflation is caused by increasing the money supply. Means you print more money and circulate more money so that if the number of goods are the same, the amount of money to buy it is more, then inflation will come, right? These are the two big theories. For zero, when we had a 15-year period of zero interest rates, the new theory came called as a modern monetary theory.
Okay.
What it basically said was whatever money you print, it's not going to cause inflation. See, inflation is the biggest tax on the middle class and the poor people.
Absolutely.
Right? Because a big chunk of their expenses goes into basics like food, clothing, education, these things, right? This MMT theory said if you want to uplift people, just print money, spend on important things like building roads or building hospitals or building schools and giving expenses to teachers and all that stuff, right? So the theory was, it doesn't matter, you just print money. Keynes also never said that you can print money unlimited, right? But these modern monetary theorists started saying that. That era is gone, which means the US budget deficits are massive. They are now, today you imagine, just 10 years back, they were paying 2% interest rate on their home loan. Today they are paying 6.5%. We in India 10 years back were paying 10%, now we are paying 7.5%. Right? So it's a big change. And US has to fund that deficit. If they don't solve this problem, it's going to be a big time bomb over the period of time. So all these tariffs and also what he's basically trying to do is trying to uplift the bottom half of the US populace. And there is no central GST kind of a sales tax or a GST tax in US. There are local body or state sales tax. The center doesn't have. So the import tariffs that he has levied, right? So for the friendly countries like UK, it's 10. For Japan, it's 15. For European Union, it's 15. For South Korea, it's 19. Vietnam, it's 19. Something like that, right? So this is basically, think of it like a sales tax. The only difference is he's not imposing it on their own population. He's calling it as an import tariff. And it's a sales tax. So it is trying to generate money to repay the debt and afford the interest rate. The third problem that they had was they financed the entire government debt with 3-month, most of the government debt with 3-month treasury bills, because 3 months was available at 0.5%, 30-year were available at 2%. They should have had a healthy mix. Interest rates, but they were in this mind frame that interest rates are going to remain zero forever. Okay, so it's a big problem. India is facing a particularly worse problem because it seems we thought that Trump is our friend, but he's ended up taking panga.
It hasn't been turned well on our direction, I think.
And unfortunately, I think they want access to our agriculture and dairy, which will be disastrous for India because even today, 40 to 50% of the people are dependent on agriculture and dairy. We don't have a free market inside India. We still, farm laws we couldn't pass. Right? Which was simple. What were the farm laws? The farm laws were instead of selling, you can sell in the mandi as well, but you can sell outside as well. Now you are restricted to sell in the mandi, right? So if you don't have a free market inside India, how can we allow US agriculture to come?
Absolutely.
Right? So India is going to have a problem. It's not going to get solved easily. Secondly, it's not a unique problem to India. It's a problem everywhere. So we have to draw parallels back to what happened in 1971 in US, okay, under the Nixon administration, Richard Nixon. So between 45 and 71, they used to have what is called as the gold standard, which meant they defined that 1 ounce of gold will be $35. It was fixed. All the other currencies like pound, German mark, Japanese yen were pegged to the US dollar. And US said that whenever you come with your dollar, so you trade in dollars. If you want to exchange your dollar with gold, we will give you gold whenever you want. Nobody asked for it. Almost nobody ever asked for gold in lieu of dollar. But they had defined that whenever you come, we'll give you gold. So what it meant was there was a certain stability to the entire economic system. Over a period of time, US, because it was the more successful economy, they started importing more, right? And there was a big balance of payment problem. And they had inflation problem, unemployment problem.
Yeah.
So they had to, as a knee-jerk reaction, rather it was well discussed and planned, but they had to give a shock to the entire world. And they gave a shock to the entire world. On Friday, they were exchanging gold for US dollars. On a Monday morning, they suddenly came and said, we'll not honor that. Your gold window is closed. Right?
Yeah.
Essentially, what they did at that time in 1971 to rebalance the global economy, they depreciated the dollar. That is also what is most likely to happen going forward. So as investors, we have to prepare for turbulent times to come. The only antidote that investors have, see again, what we have to understand is this, okay? After the gold standard was abolished and all that turmoil happened, the US market actually went up. Because now what happened was devaluing the dollar in the short term was excellent for the US economy. Right? So in 72, the market zoomed. But there was a very bad recession in the US in 73, 74.
Yeah.
Right? That's what can happen. So the time frame, so what will happen is maybe the markets will actually go up 20% in the next 1 year. But we have to be careful for the next 2, 3, 4 year period. Ups and downs are normal in any market. You have to prepare for it, have a conservative asset allocation, and prepare yourself to buy when there is blood on the street. Markets will fall for some reason, predictable, unpredictable reasons. You have to be a buyer when the markets fall.
I think you beautifully explained. I think we went from literally 1964 till now 2025. It has been almost like 50, 60 years of period. I think, but at the same time, as an investor, as you rightly said, that this is maybe the time where we should be ready. I mean, anticipate some of the fall maybe, but don't get anxiety too much hyped up. But at the same time, what I would say is that this is more relevant to the Indian investor. Imagine many of my friends, and I'm sure all of us know a lot of such people who are actually sitting in the Trump land, who are sitting in the US. And so-called NRIs, and they are looking at India as a very big opportunity from that lens, because that is what we are seeing for the last at least 5 years. But at the same time, they are also getting worried that how should they look at it, because they are actually sitting there. How should they look at investing? How should they think of this entire thing? And anything specific that Candor is doing to address such kind of concerns? Anything for someone like NRI, my friend who is in Canada, who is working at Amazon, but is actually worried. I mean, he's worried. So how can someone like you would address that?
So I have a very strong view on this over the next 2-3 year period. Okay, the time to invest in India is now, for especially US or the NRIs, right?
Okay.
There is a very high chance that the dollar is going to be devalued over the next 2-3 years. So the time to get your money into India is now. So if 3 years later, if dollar is depreciated, your same $100 is going to be worth more.
Yeah.
Okay, when you take it back, whenever you take it back, it's going to be worth more, right? Second is, of course, markets will go up and down, which means you don't need to deploy as soon as you enter India. You can have a chunk in India and wait for the correct time to deploy. So since markets are unpredictable, the best way to do it is, I always tell people, if you wanted to invest 100 rupees, don't invest 100 today, invest 33 this year, 33 next year, 33 the next year. Whatever happens, markets up, down, you will get benefited. If markets go up, you have already invested some money, so that goes up as well. If the markets go down, you have more money to invest at lower prices, right? But dollar, there's a very high chance, and we have to be open to this. And we have to read more and understand more, but there's a good chance that the dollar will be depreciated over the next 2-3 years. Okay.
So sounds like a fantastic opportunity.
It's a good opportunity.
Yeah.
But it might also, see, these are macro things, and it's difficult to predict exactly what will happen. Because what may also happen is after the dollar devaluation, there is a chance that Indian market may go down, right? We don't know.
Yeah.
Right? Or the world market, I mean, non-US market will go down. US market may go up, the non-US market will go down. We don't know what exactly will happen.
Surely.
So the only thing in our hands is lower valuations. See, at Candor, what we have seen is we have at least 15-20 NRI investors.
Okay.
And we have spoken to others also. For most of them, currency depreciation is an ongoing issue. For whatever I have explained in the last 5 minutes, I think in the next 5 years, currency depreciation is not a problem.
Okay.
What may happen after that is a different thing. But in the near term, medium term, I think US dollar is going to depreciate, not the other way around.
Oh, it's a very interesting thing because I'm very sure, as you rightly said, in the US, although the inflation has genuinely peaked right now, so they are also not able to find out what kind of multiples that they will get, because looks like even the market caps of the top 7 that we call FANG might be also hitting the ceiling. There might not be too much of appreciation for that, but India looks like that we are growing, we have a lot of opportunities, and we will continue doing that. And with the dollar depreciating, sounds like a very interesting take that you have, and it might benefit a lot in terms of investing also.
So I'll just have a slight different take. FANG is great.
Okay.
If you're invested in FANG, don't remove your money.
Oh,
you may 3 years later they may have a lower valuation. Okay,
Acha.
but they will. Most of them will probably remain the best companies ever.
Oh, very
Right?
nice. Okay.
I don't think any other country in the next 10, 20, 30 years is going to have a FANG.
Acha.
So stock price is a different thing. Quality of the company is a different thing. You may see a decline in your stock valuation in FANG because they are highly overvalued. So unless you are too extreme, I don't think you should be withdrawing money.
Okay.
Stay put. It's okay if your portfolio goes down by 30%, so be it. Others will go down more. These are the best companies.
Okay.
Fortunately, you are invested in them. Don't be in a hurry to sell.
Definitely.
But other money that you need to deploy, incremental money, is it a good thing to deploy in FANG at this time, at these valuations, in this market structure? I will doubt it. So incremental money can go to other revenues, including India.
Yeah, absolutely. And that might even give a slightly diversification kind of a bit also, in terms of country also, in terms of geographies also, because there might be some good opportunities in India, which I'm very sure you would be advising to your customers as well.
Correct.
Absolutely. And I think as we talk about investing and we go further, let's say as an investor, there is always something like as a very big goal. I mean, all of us have some number in our mind, right? Because ultimately it's about money. Ultimately, that number sometimes gives a motivation also. Sometimes it is all about dreams also. And for most of, at least my friends, what I have heard since our childhood, that number sounds to be 100 crore. Because वो होता था कि यार 100 crore club होता है. I mean, so that was the big thing when I was growing up, and in the last, I think, decade also. So if someone is genuinely looking at that 100 crore as a big dream, how do you typically advise? And definitely, is that possible, first of all? Should one chase that? That is second. But if somebody wants to chase it, how should someone approach through Candor, or what would be a generic advice on that?
10 crores is a very good number in India to lead a upper middle class life, right? Unless you want to buy 5-6 houses and all that stuff, right? After that is genuine rich money, right? So the question is, what number are you starting at, and how many years do you have? So for most people, okay, most of my clients are going to touch that 100 crore number. It's only a matter of time.
Wow.
It's a question of compound interest. So it's not a question of if they will touch. Many of them will end up touching it. It's a question of time. Okay. If you say 100 crores is almost like what, 12-13 million dollars.
Yeah.
In my opinion, $1 million is a good number. Anything above that is extra, and which is fantastic. Right? You have to be ambitious in life, and you have to be positive in life, and you have to be a go-getter. Right? Now, if you are at say 10, so let me try and enumerate the journey between 10 and 100.
Yeah.
Right? So most likely, you're doing very well in life, you have a good business, you have a good job, you're saving well, right? You have to continue saving well. At the same time, you have to, if you're not spending enough, you have to start spending.
Okay.
Right? You have arrived in life.
Yeah.
If you're about 10 crores, you have arrived in life. You have to be comfortable. You have to enjoy, right? And you have to enjoy the good things in life.
That's what money is for ultimately.
Exactly.
Yeah.
Right? So if you're not enjoying, start enjoying. Start spending more. I don't like spending more, but if you're spending less, then, start worrying too much about spending, for example.
Don't restrict yourself. Don't splurge maybe, but don't restrict yourself.
That's the correct way of putting it. Don't splurge, but, you can afford it.
Yeah.
Right? Number one. Number two, you have to keep. So if you want to reach 100, you're going to reach by both compounding, increasing your investment returns, and adding more. And your ability to add more to your portfolio is going to be very high for the next 5-10 years, right?
Yes.
You're most likely, you're 40, 45, you have done a good, maybe a couple of startups, or you are at a very high position in some good company, Indian, MNC, whatever it is, right? So your earning capability is also very high, your saving capability is high, your kids are maybe, 18, 20, they are done, whatever, over a period of time, they will, major expenses of education and house and all that is taken care.
Yeah.
So your compounding journey will be fast. The third thing I will suggest is, there will always be, you have to catch extremes in the market. That's very important, right? Markets are going to go up, markets are going to go down. So we have to be cognizant of ups and downs, not be worried. But at the same time, when the market, the easiest thing to do is to catch low valuations. So when the markets are down, we have to bring money, deploy. Wait for the amount of time, its compounding is going to automatically take care of itself. Money badega. Money attracts money, more opportunities will come. The mistakes that you don't have to make is, don't try to make it too fast. If you give it enough time, it's an inevitability. Even if you try to spend a lot of money, you will reach 100 crores. So for example, what happens after 10 crores also, I'll tell you. So people want to buy commercial real estate because they want diversification, right? Commercial real estate is going to give you 4-5% yields.
Yeah.
Index fund is easily going to give you 6-7% yield, right? With all the ups and downs. Why do you have to go there? People suddenly want to go to private equity because, there is a concept where private equity returns are not linked to the market. The reason they are not linked to the market is because they are not liquid.
Yeah.
Right? Nobody is going to come and buy for it. They are all made up valuation reports. I'm not saying private equity doesn't make money. I am saying the only reason they are not connected to the markets is because, or the index, right? If you cannot compare it to the index returns, is because there is no market for it. Nobody is going to buy. If you have invested in a startup, till the time that startup becomes successful and gets to an IPO, nobody is going to buy that share.
Absolutely.
Right? So whether you call it 100 million startup, 10 million, it doesn't matter. If the only difference is it's successful or not successful. If it's successful, then thousands of people want to buy it for a very high price. If it's not successful, it's worth zero. It's not worth 10 million, 20 million, 50 million. It's worth zero, right? So after a particular time, don't try to go to more complex products. See, there is now a big wave of private credit. So private equity to ho gaya, which is, I understand, venture capital understand, angel fund understand, genuine risk capital, right? Absolutely needed for India.
Yeah.
Private credit, banks hai na? So transparent, absolutely regulated. Why do you want that extra 2% in private credit? No, don't take those risks.
No, I think you nicely put it. I mean, looks like the advice even after 10 crore still remains plain and simple.
Exactly.
I mean, the advice looks like don't try to do too much things. If
What
you
is
have arrived,
working, double down.
Double down. Exactly, I was going to say that. I mean, you have proved that path till 10 crore. So why do you want to go and try to do something nasty and lose your capital? Because you are having that risk with maybe private equity also, maybe with private credit also for that extra 2%, which anyways compounding will take care of that. Now, I think this is a very good confidence booster that for someone who is at 40, 45, have arrived in life. I mean, the arrived in life has a fantastic definition that you are not looking at the right side of the menu. If I want to plainly put it, if you can have whatever you want, that is a good way to put it as you have arrived in life. Then you just trust the process. Then you be patient. Maybe, yes, have the right allocations, as you rightly put, that if the markets are down, put in a lot of money. If you have that much, yes, take advantage of the situations rather than waiting for those to happen. But sounds very interesting that someone who is at 10 crore can achieve the 100 crore club.
Easily.
And which is really astounding, because in India, I think we should be able to create so much more wealth. Again, because at 100 crore, people can do variety of things. And I'm very sure philanthropy might be one of them also for some of those. Now, when we talked about this 45-year-old, let's come back to his initial years, where he was 21-year-old. And someone today, I mean, we are all aware that India is a very young demographic nation. For a 21-year-old, what is that single one or two piece of advice that he should think today, and he should start doing it from today, maybe to achieve financial freedom to as much as early possible, but at the same time have a discipline in their life, have a confidence to go and have that better financial life?
So I will say, don't invest more than 500 crores in a mutual fund or any other financial product.
Okay.
Don't invest in stocks. No futures options. So for anybody, I say no. But please don't invest in stocks. Okay? And don't invest more than 500 rupees in a mutual fund. Why 500 rupees? Because you get aware of the investment world, investment process, and some discipline of investing monthly. All your money has to go to upgrade yourself. You know,
Okay.
go around in the world, take some courses, meet some new people, you know, do things which you couldn't have afforded with your parents' money. Now that you have your own money, you please spend. And you know, so the point is, see, if it is true for you, it is true for me, most of the people, right? What we were earning in our 20s is probably much lesser, you know, by a big degree, right? Maybe I think my first salary was maybe 5% of what I earn today.
Yeah, 5 to 10% usually, right? Yeah.
The big difference to your up till 30, right? The big difference to your financial wealth is going to happen through salary increments and learnings and, you know, new things. Not through saving, not through compounding. It's not going to work. It's useless. Okay? I mean, people say start early, I don't subscribe to that. By 30, you have to realize what is that field which you like, which you love, which you want to make a career, and you're good at, and you can excel. So use the money that you have to excel in the field of your choice.
Yeah, so basically be ready for your 30s so that you can jump up, take that head start and all of those things.
I'll give you an example. Not that my brother spent all his money, but see, my brother is a consultant today, right? He has a very high pay package. He's doing very well in life. And so this is 2008. So he was working with L&T at that time. He's a mechanical engineer. Okay. So he got an admission for his MBA in NITI. So NITI is a good college, top 10.
Yeah.
Right? Today, I think it's an IIM.
Yes.
Right? At that time, it was not an IIM, but it was a good college.
Yeah.
And he made a statement. After working with L&T for 2 or 3 years, if I get into NITI, it's a downgrade. And I was young. I was still in college, and I was like, what is the statement he's making? I mean, I don't know whether it is correct. Of course, he's taking a decision. He knows something. And who am I to advise him? I'm his younger brother. Right? But he had the confidence to say that. And what happened 1 year later was he got into ISB Hyderabad, right, in 2008. And at that time, the fees of NITI was, I think, for a 2-year program, maybe 3 lakhs, right? And the fees of ISB was at least 15 lakhs for a 1-year program. So I remember very distinctly that my father was with Power Grid, which is like a PSU. So 15 lakhs was probably 1.5 times his in-hand salary for a year, not 1 month, right? 1.5 years of salary. But my brother had that confidence and the foresight, right? Today he's earning like 100 times what he earned in L&T, just 17, 18 years back, right? So when you're in your early 20s, mid 20s, up to 30, you have to accelerate your learning, growth, career development. Don't worry about investing, compounding. It's all bullshit, right?
I mean, as you rightly said, if I can invest into myself and my upgradation, maybe we are creating the launch pad till I'm 30.
Exactly.
Looks like that. If I can create the good launch pad, definitely the rocket can fly much higher rather than trying to do small wins and then anyways the launch pad is not ready. But I think again at the same time, so I'm 30, I'm somewhat at 30. So let's say I have a good launch pad. And after that, what would be that one piece of advice that you would suggest for someone who is at the 30, has a good launch pad, but now wants to genuinely achieve their goals, their dreams, and are ready to do whatever as a financial advice?
Perfect. So I think the most important decision for you is, see, what do I tell my investors, right? What I tell them is, if you're taking my advice, your financial part, investment part is well taken care of for a small fee, right? Now you are free to dedicate your energy and time to things which matter for you, like for your career, your office, your business, spouse, kids, parents, friends, hobbies, that part, right?
Yeah.
So for somebody who is 30 and is doing well in career, or has that launch pad, spend some time, ask around, figure out what some online videos, read some blogs, and figure out who is that financial advisor that you can rely on. Finding the correct investor is difficult for the advisor. Finding the correct advisor is also difficult for the investor.
Absolutely.
So spend some time doing that, and then I think your advisor will take care of it.
Fabulously, I think, Amey. This has been a really masterclass where we started with literally candor as a word. We navigated the world entirely from Trump to NRIs to Indian investor, how the world is changing. And at the end, definitely what a 21-year-old, from that, how to create a launch pad till they are 30, and then how to take that jump, high jump, with the help of an advisor so that they can enjoy the life, the other life than the money, and you are ready to take care of that money part. And it has been a really, really wonderful masterclass. I'm very sure the audiences will also love it. Yes, so thanks a lot, Amey, for this masterclass, being with us. And we hope that a lot of our audience will enjoy this. And surely, thanks a lot again.
Thank you for inviting me. Thank you.
Thank you.